I've been asked to do a poetic provocation, but before I begin, I invite you all to take a deep breath in and inhale the privilege of being in my presence today. And exhale any entitlement to the gifts my presence brings you in this present moment, yeah? I come before you not as an expert in anything, but as an anointed daughter of the African soil found at the cradle of humankind. I come as the original keeper of stories, the ones they buried but could not kill. And so I ask you to listen, not just with your ears, but with the memory held deep in your bones, held deep in your blood. For the story of wealth begins with the body. Long before there were markets, before there were stocks, before there were banks, there was the land, the river, the sun. And wealth, beloveds, was the abundance of the earth. It was the song of the harvest. It was the hands that tilled the soil. It was the joy of enough. But then came the colonial lust for conquests, taking, the grabbing. Wealth became a thing to be hoarded and not shared. It became a beastly mark of power, a capitalistic tool of control. It became land stolen, bodies stolen, futures stolen. The plantations of the past are the corporations of the present. The auction blocks are now the stock exchanges. The trade routes are now the supply chains. The overseer is now the CEO. The language has changed, but the rhythm of extraction and dehumanization has remained the same. The currency of power still flows in one direction, upward, outward, and away from the many into the hands of the few. Intergenerational wealth, they call it, but what is it really? It is the remnants of old contracts signed in blood. It is the unbearable weight of past deeds pressing into the present. You are experiencing the karma of riches built on suffering, and it would be unrighteous of us to not allow you to experience the full cycle of your ancestral karma. And so I ask you, what ghosts live in the wealth you hold? What stories are stitched into the fabric of your investments? What bodies are buried beneath your portfolios? What voices whisper between your metrics? What of the ecosystems too complex to be captured by your charts? What of the sacred that resists commodification? Can you stand in the messiness of it all? Can you hold what cannot be scaled? Can you risk not just your funds, but your egoic frameworks, your fragile feelings? You who are the most powerful, are you truly able to share your power and privilege, a sharing that is required for systems change? And while you think about that, understand you will name me in this room. You will name me she, mother, earth, womb from whence you came, tomb to which you will return. You will name me in this room. You will recall the reverence for life that we have forgotten. This is not a game. This is not a fire drill. You will remember, you must remember to name me. Heed this call and name me in the fine print of emerging, regenerative future economic possibilities. For I am not a bottom line, nor am I a footnote to be forgotten. I am not a DEI variable to be adjusted for. I am the mother of every market you have ever and will ever build. So name me in this room. And while you remember to say my name, unfrown your brow, unclench your jaw, unarmor your hearts, and unfist your hands. Because remember, my loves, there's no systemic impact without deep intimacy. There's no transformation without relational tenderness. And there's no future without her, she, mother, earth, womb from which we all come, tomb to which we will all return. Name her, and may it all be well. Thank you.
Hello, everybody. Hello. Yes, thank you. Friends, we have food, so please feel free to get up and get the food. Folks in the back, if you have food already, please come up and join us. My name is Robert Strand. I have the great privilege to be the Executive Director of the Center for Responsible Business and the Nordic Center here at UC Berkeley. I am thrilled for today's Center for Responsible Business Peterson Speaker Series, Rethinking Corporate Ownership, with our wonderful co-sponsors Net Impact, the Institute for Business and Social Impact, IBSI, IRLE, the Institute for Research on Labor and Employment here at UC Berkeley, and the Nordic Center. Today also marks, we will have our annual gathering for the Center for Responsible Business, our community advisory group. Several of you will be taking part afterwards. That also includes members of our CRB Student Advisory Board. And with that, I have the great privilege to turn the floor over to one of our fine students on the Student Advisory Board. Please join me in welcoming John from our Student Advisory Board. John, take it away.
Hi, everyone. Thank you so much. I'm John Lundell-Osa, hopefully soon to be graduating evening and weekend MBA candidate here at Berkeley Haas and a student board member for the Center for Responsible Business. Can we first take a moment, though, to welcome very warmly two groups of folks, our panelists that we have today, but also Robert, Persis, Natalie, Amber, and all of the staff who put this event actually together. Can we please welcome them? Thank you. Today we're going to be exploring ownership models that operate differently from what we may be used to by virtue of bringing the benefit of other stakeholders into the center of the business. We have an outstanding panel of experts and practitioners from the field here to help unpack what all that means. Today's agenda is simple, but maybe a little different from what we're used to. In a moment, Julie's going to start our panel revolution, giving you, dear audience, the chance to ask your burning questions before the discussion. She's going to moderate the discussion, then come back to open Q&A at the end around 12:45. We'll close the formal portion at about 1:15. Then I invite you all to hang out with us until 1:30. But you don't have to go home, but you can't stay here at 1:30. You have to be out by 1:30. There are a few QR codes that are posted around the room and circulating. One is our pre-read document with basic definitions and information about the organizations and some of the models and terms that we'll be discussing today. The second is a post-event survey. Actually, I think we're going to be emailing that one out after. Please sign up, give us your feedback that really helps us design these events. And if you leave your email address, you can join our movement in starting a coalition for responsible business as we seek to connect folks working on this topic from all perspectives. And third, related to the underlying themes of this event, there's also a link to our student-led proposal for a Berkeley Haas doctrine on the social responsibility of business. Before we begin, I'd like to start with a land acknowledgement of where we're holding this event. The Center for Responsible Business recognizes that UC Berkeley sits on the territory of Huichin, the original landscape of the Chochenyo-speaking Ohlone people, the successors of the sovereign Verona Band of Alameda County. This region continues to be of great importance to the Muwekma Ohlone tribe and other familial descendants of the Verona Band. We recognize that every member of the Berkeley community has and continues to benefit from the use and occupation of this land since the institution's founding in 1868. Consistent with our values of community, inclusion, and diversity, we have a responsibility to acknowledge and make visible the university's relationship to Native peoples. As members of the Berkeley community, it is vitally important that we not only recognize the history of the land on which we stand, but also that we recognize that the Muwekma Ohlone people are alive and they're flourishing members of the Berkeley and broader Bay Area communities today. The poem that we listened to in introduction from Ashanti Kunene opened the recent Transcap Initiative's Systemic Investing Summit with this poetic provocation. I urge you to go view the whole thing if you didn't catch it, but in it she asks to reckon with our history. What ghosts live in the wealth you hold? What stories are stitched into the fabric of your investments? What bodies are buried beneath your portfolios? What voices whisper between your metrics? And what of the ecosystems too complex to be captured by your charts? What of the sacred that resists commodification? Can you stand in the messiness of it all? Can you hold what cannot be scaled? Over the last year, the CRB, under its Rethinking Capitalism initiative, has been asking questions that echo and reverberate these questions and this call for awareness and action. How are business schools implicated in the current state of the world, our communities, and the environment? What is our role in reshaping business school education? How may we culturally redefine the purpose and social responsibility of business? And what is the movement that's needed to envision, then create, the future that we need? We've explored, learned, and met friends along the way. In our kickoff on November 7th, we explore the intersection of business and democracy, the roots of our modern economy and slavery, and the ability for corporate structures to literally lead to psychopathic behavior and mindless pursuit of profit maximization. We learned from our friends at Caltech about planetary boundaries and living within the donut here in California. We conspired with Natalie Foster on creating an economy of care through public policy and halting the current cycle of accumulating violence inherent in our economy. What bodies are buried beneath our portfolios? Today, in exploring ownership models, we come to a conversation that isn't the solution, but perhaps is a solution. In my own research and work over the last year, I've explored the role shared ownership models can play in creating a truly just economy. For example, in the transition to renewables, we can view shared ownership stakes in energy and infrastructure as something more than a transition to renewables, or even more than a community benefit agreement to increase public support, or even more than a method of increasing wealth in fence-line communities. In Corey Rosen and John Case's book, Ownership, Reinventing Companies, Capitalism, and Who Owns What, the authors posit that shared ownership creates a better capitalism by democratizing it, by making us all capitalists. But we can also use the lens of non-reformist reforms. Non-reformist reforms come from the abolition movement, something tied so deeply into where our economy is. This is in contrast to a reformist reform, which would be one that makes incremental adjustments without questioning or undermining existing patterns of power. Shared ownership models as a non-reformist reform point to the ability for power dynamics to fundamentally change as ownership shifts, as these structures put something beyond the simple concentration of wealth as their underlying incentive. And what of the sacred that resists commodification? Perhaps shared ownership models gesture towards the sacred. Perhaps these models can create positive feedback loops in our cultural values and our understanding of who we are. Perhaps, when asked what stories are stitched into the fabric of our investments, we can resoundingly answer: a thriving community, an economy centered in justice and well-being for all, and a love and a cherishing of life and this planet that we share. And perhaps by the end of our time together today, we'll better understand the power and challenges this field faces. Thanks for sitting in the messiness of it all with me. With that, it's my absolute pleasure to introduce Julie Menser. Julie is an accomplished leader committed to social and environmental justice. She was the managing director and chief investment officer at New Media Ventures, where she built a best-in-class portfolio of for-profit and nonprofit startups working to strengthen our democracy. Previously, as a strategy consultant, she worked with large companies to redefine what good business means. Julie is also a co-founder of the Greener Mind Summit, a 3-day retreat for change makers in the San Francisco Bay Area. She's originally from France, where she received her MBA. She lives in beautiful Oakland, California, and loves imagining a better world by reading science fiction and nurturing life in her garden. Julie is currently the program director of Transform Finance, a research, education, and implementation partner that supports all stakeholders to challenge legacy investment approaches, seed transformative investment models, and build movement power. She's focused on mobilizing capital toward alternative ownership enterprises through investor education, community building, partnerships, and more. Please give a warm welcome to Julie in today's panel on Rethinking Corporate Ownership.
Thank you, John. Thank you, John. Thanks, everyone, for coming. For folks who are maybe coming in late, feel free to grab food and come in. Front rows are always appreciated. And yeah, very excited to be here today. There's really exciting momentum towards alternative ownership models, ways that we're rethinking corporate ownership. And you'll see in the handout, which there's QR codes there. I wonder if it's... Anyways, maybe we can pass the QR code around for folks to have if they don't have it. But we're not going to spend a ton of time on definitions, but if you look on the kind of the end of the handout, there's a helpful framework, I think, around how to think about these ownership models. Do they center workers? So that might be worker cooperatives, employee stock ownership plans. Do they center a purpose and really preserving a mission of a company? So that's perpetual purpose trusts, benefit corporations. Or do they are they really focused on centering a diversity of stakeholders? Are they purchasing cooperatives, shared services cooperatives, or other models? And obviously, those can all be hybridized and combined in ways that I think make for a really interesting, though sometimes confusing field. So I'm really thrilled that we have essentially folks who can speak to kind of this whole range and this whole ecosystem today. And before I bring them up, as John mentioned, the way we're going to do this is they will each introduce themselves briefly, and then we'll ask you, what questions do you have? What are the things you want us to talk about, right? We have questions. We could talk about things that I think are interesting, but I think it will be a better use of our time if we hear the questions you have. So as you hear them introduce themselves based on kind of what brings you to this conversation, really think about what questions do you have, and then we'll make sure this is a really good use of all your time. Does that sound okay? Yes. All right. So please join me in welcoming Greg Curtis, Executive Director at Holdfast Collective, Taj James, who's a partner at Full Spectrum Capital, and Melissa Hoover, who's a Senior Director at the Rutgers Center for Employee Ownership, and the Ownership Culture Lead at Apes and Heritage. And then via video, very excited to have Soren Nielsen, who's the Managing Director of the Rumble Foundation. So, welcome. So let's start. Maybe Soren, starting with you. Could you just give us a quick introduction, what you do, the Rumble Foundation, and maybe one line about, how is Rumble structured in a different way than most companies are?
Sure. And thanks for inviting me. So my name is Søren Nielsen. I'm the Managing Director of the Ramble Foundation, which is a Danish enterprise foundation owning a engineering consulting company called Ramble. And the foundation has been the majority owner, around 97% of the shares of this company since 1972, so a bit over 50 years now. The company is around 19,000 employees, present in 30 countries, including the US, where we have a couple of thousand employees. And the Enterprise Foundation is a very classic owner model in Denmark, where we are located. It's really something that you will find a lot of big companies have used. So some of you may be familiar with Novo Nordisk. Recently, the most valuable company in Europe, Carlsberg, Lego. There's a lot of companies who use this model, where you have a legal entity that is a non-profit legal entity, but owns a for-profit company. In our particular case, we are like the other enterprise foundations, so we are a non-profit entity that owns a for-profit company that exists in a very competitive environment. But also we have in our statutes that our board of trustees must all be current or former employees. So that makes the company not owned by employees, but it's controlled by employees. Not in a democratic process, so the current and former employees who are the trustees themselves select their successors. So we have a long list and we pick people, current and former employees, but there is a continuation in that ownership model. And I think that's my minute.
Yeah, wonderful. Thank you so much. Greg, can you tell us more?
Yeah, happy to be here. Great to see you all, and happy to be able to participate in this event and love this topic. My name is Greg Curtis. For the last 3 years, I've been the executive director of the Holdfast Collective, which is Patagonia's nonprofit owner. We engage in environmental and nature protection activities all around the world. We use excess profits that Patagonia, the outdoor apparel company that you all may know, that it generates to do this work. We have a close relationship with that organization. And I also do a lot of work with the voting shareholder, the Patagonia Purpose Trust, that is the steward owner of the business. I worked for Patagonia for about 8 years before taking on this role. Corporate lawyer by background, so this topic is something that's near and dear to my heart, and excited to have this conversation with you all today.
Thank you. Taj?
Greetings, Taj James. I help to lead the Full Spectrum Group, and the work that we do is about figuring out how we can accelerate our transition to regenerative economy through community wealth building, community and worker ownership. And so interestingly got into this work as a younger person wanting to do good. And so thought I should go and start a nonprofit, because the notion was if you wanted to do good things, you go and start a nonprofit. And I didn't realize that a nonprofit could own a company, or a company could own the fact that those two things could be in a dynamic and productive relationship was something that did not occur to me for about 25 years of working in nonprofits and government, and realizing that most of the problems that we were trying to solve required a significant role of business and capital to solve. So Full Spectrum Capital is really about, and Full Spectrum Group is really about how we kind of access all the different kinds of capital that are available to us, and leverage all the many kinds of legal structures that exist and ones that we can create to flexibly and adaptively, solve the problems we're trying to solve and scale the solutions we need to scale. So that's a little bit of what I'm working on.
Yeah, thank you so much, Melissa.
Hi, I'm happy to be here. Thank you for having me. My name is Melissa Hoover. I wear a few different hats, so I'll just step through them. I am on staff at the Rutgers University Institute for the Study of Employee Ownership and Profit Sharing, which is really kind of the umbrella academic organization for anyone studying employee ownership. I invite you to check them out. A ton of resources if you're interested in this topic. And then the other part of my time, I lead ownership culture development in portfolio companies for APIS and Heritage Capital Partners, which is a Black-led investment fund, about $60 million, that finances the transition of essential businesses of a sort of small and medium size to their employees, transition of ownership from a selling owner to their employees. And as part of that process, I help train the employees in how to understand the business that they now own. Before that, APIS and Heritage comes out of the Democracy at Work Institute, which was a nonprofit organization, is a nonprofit organization I founded about 12 years ago, along with the worker cooperative community, to expand worker ownership to communities that are locked out of business ownership and good jobs. But then way before that, I started my career as a cooperative developer here in the Bay Area with the Arizmendi Association of Cooperatives. So those of you who know the cheese board in Berkeley, Arizmendi spins off from that.
Yeah, I love Arizmendi so much. So delicious. All right, hopefully you have a good sense of who's here and the range of topics. We could talk for days, but we do not have days. So we'd love to hear what questions do you have. And what we're going to do is raise your hand, there's mics, and then we're just going to take, all the questions or many questions, and then I'll use those to weave a conversation. So what do you all want to hear about?
Hi, so I have a question for everyone, but particularly...
Say who you are, if you're willing.
Oh, yeah. My name is Livia Morris, and I'm a research associate at Berkeley Chai. My question is for everyone, but particularly Mr. Nielsen, and it's based on my reading, the industrial foundation model that's popular in Denmark doesn't really seem to be a thing here in the United States, and I'm curious what your take is on why that is.
Great. Yeah, thank you. What else?
Question. All right, here we go. And if you kindly say who you are.
Sure. Stuart Valentine. I have a question of you, Melissa. You mentioned the training of employees that are about to transition into collective ownership. I'm just curious if there's been any long-term studies that show how those small and medium businesses have performed in the aftermath of a transition into collective ownership. I just speak from being a small business owner and recognizing the challenges of ownership, that many people are very competent and well-placed as employees, quote unquote, but put into an ownership position, it's a very different can of worms. I'm curious what the results you find are.
Yeah, wonderful. Yeah, great question. What else? There's one in the back.
Hi, I'm Jenny Vaughn. I'm professional faculty here at Haas and managing director at BSR, where I lead the human rights team. I'm generally interested in hearing from all of you in how these different models help businesses better thread the needle between being profit-making or at least book balancing enterprises, but also delivering value for society.
Yeah, thank you.
All right, good. I was going to start shaming some of you. You got a free lunch. You should at least be able to generate some questions. Here we are. No, that's right.
Exactly. Not actually free lunch.
Julia Silbergeld, Haas alum, and I'm an executive at a startup that's a public benefit corporation, and really interested for those of us in the private sector, we're VC backed, interested just like what are the things we should be considering?
Yeah, thank you.
Hi.
We'll go right over there.
Sorry, Scout O'Byrne, first year MBA. There's obviously a wealth of conversations that we could be having here. But I think for me, like perhaps naively, my main question being a business school student is where's the money coming from? How do we fund these types of enterprises and how do we make the case? I think they're the right thing to do. I think they're better for society. And also, we're taught in these classrooms about the Friedman Doctrine, for example, right? And I believe that in these institutions, so my second question is, in these institutions, we reproduce the theology of capitalism. So what would you say to the people who are teaching that, right? The professors in this room, the students who are learning those models. How might you reframe what we should be learning about business today in these classrooms?
All right, thank you.
Do we have time for one more?
Yeah, let's go for it.
Hi, Franziska Rediker, Haas alum, and I'm also working with the California Donut Economics Coalition, which is a worker, self-directed nonprofit. My question is, what can we learn from examples, both internationally as well as in the US, for how to best spread the benefits of these worker or different ownership forms, and also how do we protect them from falling back into the more capitalistic model?
And when you say how to spread the benefits, is it a question around how to communicate, or is it something else? More broadly?
Basically, how to increase the percentage of institutions that or organizations that will adopt that.
Yeah.
successfully.
Okay. Great. Yes. Thank you. Let's take a couple more.
Hi, Asif Rehan, soon-to-be unemployed graduate of Haas. Everyone in this room really cares about this stuff. That's fantastic. How do we convince people who are not members of this room? How do we get the benefits across when there are things that would generate more profit?
Yes. Thank you.
I've got one back here.
Hi, Julie. My name is Sonali. I'm the co-founder of Zolidar, which is a platform to enable more businesses to become employee-owned. I recently heard, and there's lots of debate about the different structures of broad-based employee ownership, and curious about your thoughts about some of the latest debates about whether certain forms of employee ownership shouldn't be called an ESOP, for example, and get certain tax advantages, some of the concepts that came up at the Aspen Ideas Forum. So just love to hear your thoughts.
Yes, thank you. One more here? Or no, you're just saying hello. No, I think Mark was just saying hello. Go ahead.
Hi, Adrian Harris, student of corporate accounting and accountability. My question was tangential regarding nonprofit ownership of for-profit organizations. For companies that want to make that transition, what sort of tax-related and liability concerns might they have around that, and how are they resolved?
All right. I love it. Any other burning questions? I think we're good. This is amazing. Thank you.
Okay, they earned their lunch. Well done, people.
Everyone gets to have seconds if you want. Yeah, thank you all so much. I love the range of kind of more high-level questions and then some very specific questions, and that's the kind of stuff, I wouldn't know the kind of specific questions you all would have, so really appreciate it. Maybe to kick us off, let's start with this question that I think a lot of folks have around how do you balance, right? If you're a company that is structured, where impact is really driving why you're structured in this way, like how do you think about balancing the value you're delivering for society and profit making? The fact that you are a business, you want to stay in business, and you need some degree of, profits to be able to do that. Maybe let's start with you, Greg, because I think, it's like a right part of the structure is like we're generating surplus to give away. So how you think about that, and then we'll hear from others.
complicated answer, but in a way, sort of simple. For us, it's been pretty instinctual. I think I mean, 3 years since this ownership change, so there's been more options on the table in terms of, okay, now we can pull value out of the business tax-free to do all this work at a greater scale. But before we did all of that, there was always this tension between how fast to grow the business. Do we want to grow the business? Do we want to shrink the business? Do we want to make more product or less product? Do we want to go into different geographies, like this sort of extractive instincts that you're trained in business school? So I think we've always wrestled with these kinds of questions. I think our founders and his family's ability to kind of hold really difficult and contradictory sort of answers to those questions at the same time, that they felt employees who might be owners of the business might not feel as strongly or be as comfortable and might not come out to the same conclusions that they did, led us to certain ownership outcomes in our process that we went through. So I think when we've had board meetings over the years, and now that we're having board meetings where dividend decisions are being made in terms of how do you drive the business, what decisions do you make for it, should we be tougher on suppliers to generate more profit, to do more of this environmental work, that doesn't happen. But we can be more, and I think this is really the honest sort of place that we're all at right now in our company, which is that we don't really have any kind of like quantified, we want it to be this percentage or that percentage. We don't have any minimum dividend that we look to deliver. If anything, I'm kind of, at the end of the line in terms of what they're really caring about, because what was most important and has always been most important is how we treat employees, how we make product-making decisions, how we work with our suppliers. So all of these sort of first principles have always stayed the same. And I think we're just getting into the space of, the uncomfortable space of how do we make profit distribution decisions and business decisions for the long term with that in mind, and should we? Should it always be sort of the second priority? But there will, in years where there is a residual, we can use that for that work. And so the structure that we built doesn't require any kinds of distributions. There's no minimum amount in terms of like a 5% distribution that some nonprofit organizations have to deliver. So we've built something that gives us that flexibility. For me, that's an ideal, that's a good outcome to be at. At the same time, it's not, you don't want it to be so comfortable that you don't kind of do the work to figure out a more programmatic methodology, so you're not always reinventing the wheel. It's one thing to kind of have that conversation now when the founder's alive. 20 years from now, when they're not in the room, what would they say? And having that written down is really valuable.
Yeah, and I appreciate the transparency on the iterative nature of it in this moment. I mean, Soren, you've been doing this for decades. How do you all think about this?
There's also a very long answer as to how or why we ended up where we are, but I can speak to how we're doing it, because I think that was what was questioned. So the balance between profit and value creation for society right now is something that we're discussing all the time. I just came from Stockholm yesterday, where the top 200 in the company were together, and I spoke on this topic exactly for all of them as representative of the owner. But we have an annual communication from our board of trustees. So the owner tells the company in what we call a owner's guidance, which sets out a number of loosely defined areas where we want the company to perform. So it can be both financial performance, but it's mostly non-financial performance. So we want the company to focus on areas where we think society is in need. So biodiversity could be one thing. And then we, together with the company as the owner, take decisions, for example, in transitioning out of oil and gas, which we did 7 or 8 years ago, not because it was not profitable, but because we thought it was the right thing to do at that time. And so that balance needs to all the time keep the company competitive. And while we may take some short-term decisions that are not good for profit, we like to think, or we know now, because we've been doing this for over 50 years, that in the long term, they will be profitable because it attracts the kind of employees we want. It also paves the way for long-term thinking. So with our ownership models where we are not listed and the company is owned by, I would say, a friendly entity, that is designed only to own the company. For example, the financial crisis and that kind of situation sort of, it doesn't really hit us that hard. We are almost debt free also, so we are really in a position to take our own decisions for the long-term benefit of the company, but also for society. And it's an engineering company, so we like to think of the company as a big impact investment for the owner. So we also have philanthropy on the side, and we can talk about that later, but we really like to steer the company in doing the things that we think is needed for society. Yeah.
Yeah, thank you. It's really helpful to hear how it works in that context. And maybe Melissa, we can talk about that, and you can flow in that question we got around kind of the performance of employee-owned companies.
Sure, yeah.
and what the research shows.
Yeah, I want to take a swing at this one because I can answer it, I think, on a couple different levels. So at the head-heart level, I hear a question underneath the question in several of the questions from the audience, which is, I think, the question, how do you balance the two? How do you reconcile those? And I just have to say, I think business schools, present company accepted, have really done a number on people's heads. The fact that, that those must necessarily be opposed, or the notion that profit maximization for outside shareholders is the most important, perhaps the single reason to go into business, is not just boring and potentially psychopathic, it's also ineffective. We have data from employee-owned companies over the last 40 years of studying them that shows when employees own part of the company and are engaged in participating in making it better, those companies are more productive and more profitable. And as Soren speaking to this in the long run, certainly true for the other panelists, that it's not an irreconcilable binary. I in fact think that deeper, broader participation drives enterprise value. It makes businesses more resilient in the long term. So I just have to completely reject the framing that those are opposed. At the sort of practical level, I think it's an interesting question though. And there are a ton of different ways to try to answer it. At the Rutgers Institute, we try to answer it in the framework that's used by investors and business schools to say, even within your framework, if you look at employee-owned businesses, you'll see that by your standards, they are more successful. I think there are other approaches to this question in the spirit of non-reformist reforms. You can develop new frameworks. We evolved these big old human brains for a reason, and it's to be able to deal with questions like this. So I'm interested in kind of this notion of metrics and data and being able to measure both the sort of the standard measures of business success and a whole new set of values that are present whether a business school framework acknowledges them or not.
Yeah, thank you. Taj, very well said. Taj, you said in your opening remarks, and it's the idea of full spectrum capital is really navigating that tension, right? There's some capital that is maybe not maximizing profit. There's some areas that are balanced. There's some areas that are maybe more philanthropy. How do you think about that balance? And it's like there's always are there win-wins? Where are the limitations of win-wins? And in this context, how do you come to this?
My favorite economist is Dr. Martin Luther King Jr. And in 1967, he sort of asked this question of whether we could transition from a thing-oriented society to a people-oriented society, which has to do with the basic and most fundamental human question of what is sacred, what is important to us. As a human being, as a dad, as a neighbor, as a coworker, right? What's important to us? And I think that the thing that we're remembering, and the thing that's true, is we get to decide that together. As a company, as a country, as a community, as a species on the planet, we actually get to decide what's important. Eco means home. Economy means the management of home. right? And we are grappling with what Dr. King called a radical revolution in values. Like this sense that that we've built our companies and our economies and our civilizations around the notion that like some of us are subjects and some of us are objects. And that subjects get to act upon objects. That's what he's saying about a thing-oriented society. So am I a subject or am I 3/5 of a subject? Because at one point in this country, my ancestors were objectified, right? We are objects, not subjects. Subjects get to act upon objects. So just to kind of, what's wonderful is that once you decide what is important, you can organize governance, ownership, management, distribution around whatever those principles are. And that's, I think, the exciting thing for those of you who are students here. It's almost anything is possible if we can agree about what's important and organize ourselves around it. And so, the work that we do in Full Spectrum is, we're going to take grants and debt and equity and venture and new market tax credits, and we're gonna organize all of that capital in relationship to whatever goal it is we're trying to achieve, not defined by tax status or role or structure, but defined around purpose and people. What's important? This is the purpose that's important. These are the people that are important. This is what we're trying to generate through economic activity, and we can organize our economic activity towards that purpose. So, taking a few steps back, culturally and philosophically, that's the exciting thing about where we're at. And that this conversation is happening here in this institution and the institution that you're connected to, and in so many institutions, is an indication that there's a growing understanding that you can do what Patagonia did. And so right now when we work with entrepreneurs, we do this thing called the reverse Patagonia. We call it the reverse Patagonia, meaning if you look at what Patagonia did in a linear and sequential fashion, if the founders of the company knew that was what was going to happen at this point, how could you have reorganized your business structures? And we do that in such a way in order to say, well, if you have the intention of doing what Patagonia did, you should have access to capital on more founder and team-friendly terms with less effort, because you've already made a commitment to redistributing the good that you produce in a way that both helps investors, workers, communities, and the environment. If you make that commitment on the front end, capital markets should be organized in order to incentivize that. Because the last thing I'll say is that the biggest limiting factor in all of this, which got raised here, is like we have the economy we have because we have capital that created financial incentives to produce and reproduce that economy. The biggest limitation on everything that we're doing is about the availability of capital that's incentivizing these forms of economic organization, which is why there's a $60 million fund to do this and a $100 million fund to do that, and you're redeploying capital in the ways that you are. And I think the thing that I'm often focused on is helping folks who want to do good in the world in whatever ways they want to do good, understanding the power of business, cooperative enterprise to do good at scale. Because what I'll say is, like, there are ways in which nonprofit and government are fundamentally limited in relationship to the problems that they can solve at scale. Business is how you do things at scale. Government, to some degree in Europe, it's different than it is here. It's different in different places of the world. But here, business is how we scale the things that we want to scale. So whatever it is, understanding these models and how the term sheets and the and the profit and loss statements and the accounting rules are organized and structured, like the details of all of that matter in terms of creating the kind of businesses we want, cooperatives we want, and social and environmental outcomes that we want. So
Thank you. I feel like you've laid out like where we're going, where we've been, and where we're going next. Because I want to keep this scale question for the end. Like, how do we scale, right? But then the thing you were opening up here, Taj, really nicely is this: how do you make it happen, right? Capital. We had someone from a venture-backed startup. Where you're like, at that point, you've taken on venture capital. So we'd love your thoughts on. How do you choose and how you make it happen? And so maybe a little bit more in the stories of maybe, Soren, we could start with you again to talk about like how did the Rumble Foundation come to be, right? Was there external capital needed? Yeah, let's start there. Get a little bit into the practicalities of it.
Sure. And I think one of the reasons that we have so many enterprise foundations in Denmark is simply because the legal structure was there early on. So it was not for the few, but it was always intended as a mainstream way of organizing. It was supported by laws, regulations, and also we now have for the last 30 years an authority, so a public office which only has the job to oversee the enterprise foundation. So there's transparency there. So I think that matters a lot, and I think Greg can speak to the difference in the US model, where you can do it despite of the legal structures available, whereas for us it's more been supporting structures that were there. So that's the general thing about why we have so many here. Then for the Ramble Foundation, it was about the founders. So the two founders of the company were one was a pacifist, the other was a vegetarian, and they were writing books on philosophy while they were doing their engineering. So for them it was always much more than just a company. It was always intended to do more than just make a profit. They wanted to rebuild Europe after the Second World War. So when they got older, they needed to put the company in good hands. And so for them it was really a question of succession. In a way they could trust that the thinking that they had led the company by would be kept there forever. And then the legal structure was there. So it was easy for them. They just needed to take the decision. And actually in 1972, they gifted the company. So they were not bought out. They gifted the company to the foundation, the only condition that they could stay on as employees forever, and which they did. And now they are gone. But the intention was always for the company to simply follow the philosophy of the owners forever and make a profit while striking that balance between the profit and the societal ambitions.
Yeah, and that piece on the founders walking away, right, gifting the company, I think is a pathway similar to the Patagonia pathway. So maybe you can just touch on that. And there are other pathways, right? So just so we can touch on those as well. But maybe tell us a little bit about the Patagonia story there.
Well, maybe before. So what Soren is talking about, what's really interesting about both Rumble and Patagonia is, I mean, you're talking about founders who started and began from a very purpose-first place. Both of these companies grew up at a time when things were slower. There wasn't the velocity of change wasn't so great. Capital markets weren't so developed, and they had limited ownership at the beginning, and so there was this carrying period where purpose and business success and how to make these decisions kind of grew up one and the same. Today's environment that you all are graduating into, it's like high velocity, quick returns, grow, grow, grow. I mean, that's sort of like, that's the world we grew up coming out of college. It's sort of like what you did. So it's what everyone's talking about. It's what people are telling you need to do to get funding. But, if we were in a world where every founder now were making the decision to start a reverse, start with a nonprofit, start that as a purpose steward owner of a business, whatever that structure is. And if that's what every VC fund had to now sort of compete against with other funds, like they would change very quickly. So there's just this, it's like, it can happen. It's just slow. These transitions, we're sort of in a cycle. And I think we're at the beginning, hopefully a little past the beginning of a new cycle of people doing things differently. And I do think capital is a little bit of a chameleon. I mean, everyone wants to have the opportunity to talk to those innovators and those new thinkers and business leaders. And so I think And I've talked to funds since we've made our change where they're trying to understand it so that it can be a competitive advantage to be able to appeal to the types of entrepreneurs I think you may want to be. So I think this landscape is really changing quite fast. In terms of I could go on about our ownership story, but maybe I'll stop there.
Yeah, thank you. Yeah, and I appreciate you opening that piece around capital and how it will follow good entrepreneurs. And I think it's been interesting to follow, like OpenAI's, is still maybe nonprofit owned. Anthropic is structured kind of as a trust ownership component. So these big, kind of very visible startups are using alternative models. And I think for all the vagaries of it, really showing that it is possible to raise capital and do it, and in the process making everyone more familiar with those models. So I think there's a lot there. Melissa, how does it work with employee-owned companies? How does the capital come together? Yeah.
Yeah, well, similar to sort of Soren's point, there is a legislative regime and a set of enabling laws that helps ESOPs and gives them a substantial tax advantage.
ESOPs?
ESOP is an employee stock ownership plan. It's by far the largest form of employee ownership. There are worker cooperatives, a really uneven by state set of enabling laws for worker co-ops. Employee-owned trusts are coming on to the scene. Still, I think, to be determined, but ESOPs are the big dog in employee ownership. They're complex, they're highly regulated by the federal government, but they do have pretty massive advantages for 100% ESOP companies. And investors see that. And they see the value proposition and the data that I cited about those companies performing and being more productive. So I kind of want to make 2 points. One is, how does the capital come together? And the other is, how do we anticipate our success when more capital wants to come together into the space? Because that's where we're at. So the capital comes together around, you can finance an ESOP deal with very little concern for ownership culture or equity, or and by that I mean racial equity or gender equity, or worker participation. You can transition a business to ownership, and there's plenty of capital for that. Actually, there's probably more than is being deployed. The purpose-driven capital that really focuses on, for instance, low-wage workers or high participation cultures, by and large, follows the kind of business logic. So to your question about collective ownership, it's not a collective, it's an ESOP, and so there is a shared ownership strategy that is relatively equal, although ownership proportions vary by position in the company and compensation. But it's certainly not collective management. It's a pretty traditional management structure. If you look at the org chart of most employee-owned companies, they look a lot like other companies. They are there to do their business and to operate in the market. The structure looks the same, and sort of in that sense, they're there to maximize their profit as well, right? But for the benefit of their employee-owner shareholders. And often for other stakeholders. Not necessarily, but often that is true as well. So, it's an assessment of risk and return that investors make that is pretty familiar to them, with this possible added bonus of higher productivity and better resilience because of the employee ownership. And then when you add in the sort of deep investment in ownership culture, which is my experience at Apis and Heritage, you start to see really transformative results for workforces and for communities. And that is because they're purpose-driven investors. That's because it matters to them. But they are taking institutional capital, which would prefer that it not get lost, right? So they have to make sure that they're protecting their capital, that they're analyzing the risk of those business investments just like anything else. So I think I just want to make that clear. We're not doing something crazy. We're doing something pretty recognizable with an extra layer to it. And because there is so much interest in this model, we're starting to see capital actors in the space take it up. Right? We think it works. We love it. We think it's great. We're evangelists for it. But I think generally, and I don't know if this is true across the other forms, I'd be curious, we're totally unprepared for our own success. like if there's more capital flowing into the space, could there be more A&Hs? Sure, but it's not always going to look like A&H. It's going to look more like KKR, private equity giant, that wants to grant a one-time ownership share because they understand that it drives value in the company. And so when they exit, when the company goes public or sells to another buyer, it's more valuable. And the employees get a share of that value. They're calling that employee ownership. It's not perpetual employee ownership, it's one-time ownership. They do invest in ownership culture because that drives value. But at the end of the day, the long-term trajectory of those companies will likely not be employee-owned, although it varies by deal. There's just a lot of, so that's private equity, right? Private equity is going to bring private equity tools and private equity logic into the space. They're already sort of purchasing ESOP companies because those are high performers. There's a lot of foment, and I think if we don't, and this is true for sort of all of us, I think, who are interested in alternative structures or alternative logics, if we don't anticipate that and help guide it and have a container for it, we're going to be playing defense against it or rejecting it, or sort of uncomfortably embracing it or fighting with each other about whether it's real. None of that's productive. So I guess that's what I'll say is I think we should anticipate our own success.
Yeah, that's wonderful. And so someone asked what A&H is. It's Apis and Heritage, which is a fund that converts companies to employee ownership. I'm sure you all know KKR, but they are leading an effort called Ownership Works around giving company employees phantom shares, like 3 to 5% of companies so the employees participate, get a little bit of a bonus when the company then gets sold again. And there's vigorous debate in the field of employee ownership around. Is that employee ownership? Not really. I don't think so. But that's kind of what Melissa's alluded to, right? Is like, well, that's the model that has so much capital behind it, and so let's think about what it takes to scale up these other models too.
And I think even in, just to add on to that, other kinds of public companies, there are stock grants, restricted stock units, stock options. Those are much more common in really large and public companies. And I think there's a choice to make there about whether and how that comes under the umbrella too, because you can convert a bunch of $20 million, 100-person companies, but at the end of the day, there's a big chunk that are being left behind.
Yeah, exactly.
Can I ask a follow-up question?
Go for it.
So when you describe private equity coming into the investment marketplace and looking to invest in cooperative enterprises in ways in which it will kind of serve the goals and interests of that capital, right? Is there any alternative to having competing, in your words, purpose capital that is available at a similar scale but on different terms? So if I'm seeking capital for my business, I've got private equity on Monday and I've got purpose capital on Tuesday, right. And private equity is offering this much capital in these terms and purpose capital is offering this much money on these terms. Like, if purpose capital can't deliver capital at the same scale, is there I'm looking at my friend Joseph here, who started Oberon and Oberon Capital, and Oberon sort of, I think about it as like the distributed Mondragon. So it's growth through acquisition. Like it's purpose-led private equity, right? We're going to find a bunch of small healthcare companies in the Northwest, and we're going to acquire them, and then the members of those small healthcare organizations become member owners with full shares and full votes. So it's ownership and governance, right? So Oberon's sort of one of the alternative capital models for purpose-driven private equity. But Oberon Capital is how big? Yeah. So I guess. I mean, what's the question? You've been at this for a while. So the question that you're proposing around like being ready for our success, like how do we get scaled capital on the purpose side to compete with the scale of private equity on the extractive side, just sort of essentially bringing an extractive lens to cooperative economic activity.
Yeah, that's it. That's the question. I mean, I don't know if I have the answer. I want to offer just a slight correction. I don't think private equity is interested in cooperative enterprises. It's interested in ESOPs. ESOPs are bigger, and this is where the devil's in the details. You know, you go to the micro, macro thing. The legal fiduciary duty of an ESOP trustee is to maximize benefit for the shareholders, who are the employees, right? So when private equity comes and makes an offer that's too good to refuse, it might be literally legally too good to refuse. So that trustee may be required to sell the company, right, to that bidder. So I think there are a bunch of different levers to pull. One is the aggregation of capital so that we can compete. Another is sort of tinkering with the form so that it may be friendlier to that kind of investment. I mean, I think these are the questions. I wish I had an answer. I think that's what these brilliant minds in the audience are here to solve. So hopefully you guys have an answer by the end of this session on this, and maybe others do.
Well, I was, as you were sharing, I think Purpose Capital eventually, and maybe really soon, will be essentially private equity. It's just part of a problem with what we have today is there's just a lot of existing pools of capital that, you know, promise their limited partners, their investors, that they were going to receive a certain return, and the return profile for some of these purpose-led investments might be it's transitory. It might be a little more fixed and below the return levels that, you know, reputational harm for some of these investment managers, and so there's this you know, oversold economic returns and economic outcomes, and that's just a structural problem that's just going to have to, you know, there's going to be some car crashes there. And I think there are other types of capital pools that have been for a long time serving multi-generational family-owned companies, you know, where they kind of facilitate when they have a tough year and they need I mean, there's this sort of shadow banking world that exists that I think is a good proxy for what purpose could become, because that's essentially what you're looking for. You're looking for a friendly investor that isn't necessarily looking for long-term rights, could be in for several years. You could finance them out as the business grows, as you know, you're getting customers and sort of engaging with your brand that's purpose-led, and that sort of leads to economic outcomes. So I think this can all, we're just in early stages, and I think there's a lot of opportunity, and that's one of the things that we've been trying to do, or, you know, what if we had needed a buyout, essentially, like who is, and we had conversations like this, if we were going to bring in a minority investor, you know, we were thinking about it initially in a traditional sense of a permanent minority investor, but there are other examples. Organically Grown company out of Oregon is a good example where they were able, in a very bespoke way, to cobble together an investor that is going to be on their cap table for a short period of time. And that was sort of one of a kind, and we saw that early on, and like, that is interesting. And so more of that, and I think that is just part of, we just need some leaders to step up and take those risks. And then I do think the existence of those investors will facilitate conversations from other boards and other entrepreneurs, because right now it's just not an option. And people that they're going to talking about this, like, well, you're crazy. Like, why would you do that? You know, sell your company, give it, you know, create your own foundation, and that's how you do good. Yeah. And so we're just in this messy middle right now, I think.
Yeah, definitely.
I would say, even though I'm skeptical of the KKR, and I don't want to be naive about private equity, you know, suddenly having a change of heart, but I think it's positive. I know that Pete Stavros within KKR, who led this equity initiative for employees, took a lot of heat and had to sell it pretty hard, even to give a teeny tiny little bit of the fraction of the value of the company to employees. And so, you know, I think actually that it's brave and important what he's doing, and I think it creates a strategic lever where there was not one. Yeah. Where you can say, it's a tiny portion, it should be a bigger one.
Yeah. And it's, I think, to your point, Greg, about building familiarity, right? There's a sense of the more that we are showing these models exist and showing how they work, how it's not one size fits all. There's a range of possibilities that expands the imagination for how companies can be structured and kind of the capital required for it. So maybe to close us, I almost got the hook there, and then we'll go to Q&A for anything that we didn't quite get to, or hopefully new and better questions or deeper questions you might have. Let's keep talking about this that we were just getting into around How do we grow? How do we convince others? And a little bit, like, what does this mean about the shape of our economy? Because I think there's some threads of this work that are very much within the current context of investors, how they work, the economy. Like, this fits right in where we were talking about ESOPs and, like, you get a good return, why not? And then some of this is more like, someone used the term the theology of capitalism. Like, what of this is pushing back around some of these doctrines, some of these senses we have of the right way to do business. And, Tash, you touched on this a little bit in the beginning, right, around are we oriented around things, around people? But yeah, maybe think about, of these, it's kind of a bigger question than we can answer in the few minutes we have, but how do you think about where we're going and what this means about what our economy looks like? So I don't know if anyone feels inspired and wants to start. Easy question to close. Melissa.
There's a lot of foment about the ownership economy right now. Employee ownership, trust ownership, broad-based ownership. And I think it seems new and it feels important, and we're in an extremely dysfunctional political moment, to say the least, and an extremely dysfunctional economic moment, and they feed one another. And in particular, I think the economy feeds the politics. Inequality is not good for human communities, in my opinion. And this notion of ownership economy, and when people say, well, employees need skin in the game, or if communities have skin in the game, that then they'll be really committed to it. I think that's just another way to say something that's actually been a pretty old and long-standing part of democratic theory. I was just reading something the other day on the EOWD newsletter, if any of you all know it, citing the philosopher John Rawls. Bear with me for a second. So he's trying to reconcile freedom and equality, which can be seen as sort of opposed to each other, right? Maximum freedom. So what maximizes freedom and equality? And his answer is a property-owning democracy. And if I think about that, it's just the ownership economy. It's just skin in the game. And I think business is such a powerful engine. I love business, so practical. It is how things scale. It's fun. It's what we have to do 8 hours a day anyway, so we might as well, make it good. And it's powerful. It also is a productive asset, and there are only a few ways to build wealth in this country. To be a property-owning democracy, you can own a home. That's farther and farther out of reach for people. You can own land, or you can own a business. You can own investments. I guess there's sort of investments, home, and business. And business is the thing that's most accessible to the most people. And we're increasingly getting creative with different kinds of business ownership. That's a productive asset that will continue to generate wealth. So for me, that's the exciting part, is like, it's real weird to be optimistic right now on today in this moment, but I am optimistic that if we can figure out ways to broaden business ownership for purpose, that we have a shot at sort of reinvigorating our democratic space as well. So I don't know if that's what you're looking for, but that's where I was headed.
That's great. And maybe, Soren, in contrast, right, to the current, where our heads are at in the U.S., like, how do you think about this? And, right, there was a question in the beginning around industrial foundations are so common in Denmark. How are you all thinking about scale? You're like, oh, we're good, success, or what are the ranges of growth, and how you all think about what it means for the economy in your context?
Yeah. So for us, I think we were always, as a country, conscious of being a very small country, so 6 million inhabitants, but also at the same time a very open economy. So Denmark was also always about trade, so we needed open borders, and we also needed a way to protect our companies, really. So if you go back in history, the Enterprise Foundation was, now I'm going 100 years back, was originally also a way of really keeping ownership within the country. And then the purposefulness then came a bit later, and now that is the dominating factor behind the enterprise foundation. So I think I think it was great to hear you talk about the access to capital, because I think since the Enterprise Foundation in our context is such an integrated part of our business community, so I think 25% of the private GDP is generated by enterprise-owned companies. You have 4 out of the 10 top listed companies on the stock exchange are owned by majority enterprise foundations. So it doesn't really become a question of. It's rather an advantage, really, if you're seeking capital, to be owned by an owner that has not their own personal profit, but the company's profit and the company's growth and the company's standing in the world as an objective. So where we are, I think we've come to a place where access to capital is at least as good for an enterprise-owned company as it would be for any other company. It's rather, if you are a private equity investor looking to invest, you would rather be talking to someone who really loves the company and will be a very, I would say, a kind and long-term co-owner while you are there. We can talk about the profits, so you shouldn't have some weird ideas about what you can and cannot do, so it'll hurt your profits, and some of them do. But that's a discussion to be had. But the basic access to capital is the same, and the access to growth is the same. I think what has made some of the enterprise-owned companies so big, because some of the biggest are that way, is because they were able to take these very long-term decisions. So they were not driven by short-term profits, or they were not, or buyouts or whatever. They simply could weather the storms that were there, whether they were like a financial crisis or hostile takeover attempts or whatever. They just sailed through the whole thing because of their ownership structure and just grew steady. So I think there's a growth journey there, but it's not a quick one. So it's not the exponentially growth you see some are looking for and then an exit. They are defined by not having an exit. That's exactly, it's perpetual ownership. So by not looking for that exit, it allows you to do other things, and it also allows you to draw other employees and actually other customers too, but that's another story. Perhaps Greg can talk about that.
Yeah, and this point on the different growth trajectory, I think, really touches on, Greg, what you were seeing, kind of what this time is and what is cool also to do, and the sense of what the norms are. There's a lot of that it, I think, touches on. Like, you can be a successful business in different ways. Don't just have to do the hockey stick. How do you think about this moment and where we're going?
Well, what motivates me is that I get the chance to share our experience and what we're learning. I've had the opportunity to visit Soren and a lot of the other enterprise foundations in Copenhagen, which is amazing, and I think one of the best kept secrets in capitalism. It's incredible. So I get to talk to a lot of entrepreneurs, investors, startup, sort of well-established, like looking to invest in mature companies, capital providers, and everyone's very interested in trying to, just like we were ignorant about what Danish and Nordic capitalism looked like 10 years ago when we had the opportunity to meet some of Soren's colleagues. I think a lot of people are trying to accelerate and catch up and understand what is this new wave, and have a presence in it and develop a reputation in it. And I think, so that gets me really excited. I see investors trying to form. I see entrepreneurs, like you mentioned, OpenAI and Anthropic. We'll see what happens with OpenAI. But I think sort of the secret's out. You can do things differently. It doesn't mean that you aren't fundable anymore. And in fact, it might actually make you more attractive as a company to fund because you care. And, sort of some of these iconic investors who had really strict principles about what made them want to do what they have created, have always been the hallmarks of someone, like, you invest in the individuals and rather than the business idea potentially. So I think this is just another dimension to the same thing, and structurally coding it in so that you don't I think that's what people are doing now. Like, you are putting these structures in place rather than waiting until you have the exit and sort of scrambling to put something in place. So that's exciting. I think it's going to be a period of dynamic, a full spectrum of people making different types of decisions that are important to them, important to their founders that they are a part of. And you know, one of the things that I'm trying to commit time to, and I think all these panelists are, is educating, talking, and encouraging the formation of the funders, the entrepreneurs, opportunities like this, because we do get to decide what that future is going to look like together.
Yeah, definitely. Taj, how do we grow to what economy?
Yeah, I just appreciating the European context and just sort of the scale of more purpose. What's possible when you have a significant percentage of the capital available that's structured for purpose meaningfully. We tend to think of the threshold as like a quarter of the available capital, a third of the available capital will sort of have a systemic effect on how an overall economic marketplace evolves. So we're, if we had to compare there to us, we're probably at 2 to 3% to 25%. So what is interesting though is ways in which, when we think about philanthropic assets, most of which are invested in the stock market and public markets, like most philanthropic assets are not structured as investment purpose capital. If we could convert half of philanthropic assets invested traditionally in public markets into investment purpose capital, that's one of the ways we can start to increase the overall percentage of capital available for this kind of work. But one thing we haven't sort of talked too much about, because this conversation can tend to focus on sort of the oak tree, not the oak grove, the redwood tree, not the redwood grove, but to the degree to which in an economic ecosystem, the kind of changes that we want to generate require coordination and cooperation and alignment between multiple enterprises and entities. And Oberon's an example of that, and the work that you've done for many years is about not just the individual enterprise, but the sort of the ecosystem of investors and cooperatives and activities, and sort of the ways in which that's essential to the shift that we're making. Fundamental to that, I think, is in the economic transition that's happening, the balance between globalized economic activity and localized economic activity, that economic localization, which means more democratic worker and community control of land, labor, capital, creativity, and energy, is sort of essential to getting at some of the issues that we're looking at. So I think we haven't talked about it so much today, but I think the question of sort of how we, on a capital basis, on an entrepreneurial basis, on a enterprise basis, sort of what are the strategies for economic thriving within the democracy, within the economy, within communities, within bioregions, within cities, and I think that's the cooperative worker ownership is an essential piece to that, but I think that to me is probably the most essential thing for us to be focused on if we want to create an economy that's going to work better for people on the planet.
Yeah, thank you. Thank you. So we have about 10 minutes for questions, is that right? What questions can we attempt to answer now?
I'm going to go first.
And if you kindly say who you are, if you'd be so kind.
All right. Hi. My name is Joseph Curitan. Yeah. And you are? Here and a dad. All right. So, yeah, the thing that strikes me about this is I love the sort of Rawls property owning democracy sort of thing. It strikes me that we are talking a lot about redistribution versus sort of moving towards abundance. Let's just use that word as a thing. And I'll see your roles. I'll raise you a Bastani, sort of like the fully automated luxury communism sort of world, right? How does what hasn't been invented yet is really my question, right? So what technology hasn't been created that would enable this to work better at scale? Sort of what regulatory regimes haven't been thought of yet? What sort of market enabling infrastructure, hasn't been created, isn't here today? I think words are like thin skin over human experience, right? So what organizational structure, what other skins haven't we created over the way that we want to organize towards purpose? What's not new next, if that makes sense?
Yeah, what's next? What's missing? Wish list? Dreams?
An answer, I think. So I'm a corporate lawyer, so I just always have approached things as structure, to your question, what doesn't exist? If this happened, then that. And I've tried really hard to stop thinking that way because I was trained that way. And I think what is missing is people who care. I think it just kind of comes down to it's not about structures, it's about what are the goals, how well communicated and shared are those goals, how do you organize a community around those goals. It always comes back to people and what works the best for the most people. So I think it always comes back to that, and so I think we just need to organize that community and collaborate more, share more, and build that grove. And I think there's always something to me is if we could just build this, then that would this, and then that would happen. And for me, it's just I think we have all the raw ingredients that we need. We don't have to wait for. And certainly we're going to be waiting for a long time if you're looking for any kind of federal anything. So I think that's how I feel. I think we have what we need, but it just really comes down to people.
Yeah. Who else wants to weigh in?
Just to double down on that, I don't know what the next thing is, but if it doesn't fall into a world where people have both technical skills and people-oriented values, then it just gets corrupted in service of what we're seeing now. So I sort of, I think, this is a plea directly to those of you guys graduating and picking up skills, is I think we need people with hard technical skills and deep human intelligence and values together. I know that doesn't sound super revolutionary, but it's really hard to find. Oftentimes if you have technical skills, you get trained and socialized into a system that is at odds with your values. And if you have values, you get taught, you go work in a nonprofit. And I think, there's a middle ground there that's so much more interesting and fruitful, and you have to make it yourself. But it's, I think the four of us, are examples of having done that. So my plea to you is you're the next big thing. I know you hate to hear that, but that's true.
And we didn't have time in this conversation to go through everyone's kind of career trajectory, but, in the mingling after, I encourage you to ask, because it is, interesting, right? How you navigate is less clear than you go into this and then you have a career figured out, and it's more fun. Yeah.
Just a comment?
Just to double down a little. Oh, go ahead.
Sorry, go ahead.
Sorry.
Yeah, I was just about to say that I agree. We are very conscious that we need to nurture a culture of acceptance that this is the right way, both internally in the company, but also in society in general. So that's also why I do things like this, really talking about what are the good reasons, and if we do this together, then the acceptance will be brought. So there are other actors working to, I would say, pull what we're doing right now into another direction. Say that's a complacent kind of ownership. It's not real capitalism. The market will always win, and we're saying that this is real capitalism. The ownership model is a for-profit company in a cutthroat competitive environment. But it's just owned by a benevolent owner that also spends his money on philanthropy. That can work, but the acceptance needs to be there. So we have to work with culture. So if we were to lose that culture, it would be a big problem. And I think if you are looking to nurture an environment where this ownership models come, it has a lot to do with culture and accepting that is also is not a weird, radical thing to do. It's just something we do together. It sounds simple, but I think that has a lot to do with it.
And it touches a little bit on this interesting tension, right, of like rethinking corporate ownership. Like some of these structures have existed for centuries. Like some argue that the cooperative form is like the first form, right, of organization of corporations. So we are in an interesting moment of change, and we shouldn't hold it as weird because it's been around forever.
Yeah, I mean, before corporations, trusts, before trusts, community, the commons, and cooperation. So it is a return and remembering for most of human history, we've organized our needs without corporations. They're a fairly recent human historical invention. They have their strengths and their limitations. But and culture-wise, just the fact that this conversation is happening here, that there's work within this institution to make this something that when you come here, you can learn about, or if you go to any business school, you can learn about. The fact that that's not a predominant fact is part of what is shifting in the culture in relationship to this. I sort of think about it in terms of if we want to get something done, I want the most creative, innovative, motivated people to have access to all of the tools in the toolbox, right? Why would we tell you there's only a screwdriver in the toolbox? Like, that's of no value to any of us. And worshiping screwdrivers is a pretty crappy religion. Like,
I don't know.
Like, worshiping tools is a pretty crappy religion. Like, let's not fixate on the tools. Let's figure out what is our purpose. Like, what are we trying to build? What are we trying to create? What are we trying to grow? And let's use the tools in service of that. So that's another part of, sort of shift in culture. And to sort of go to this question of whether what's most critical is new solutions, new innovation, new combination, or I think scaling Oberon to the proper scale, scaling the things that you've built and a work to the proper scale, taking the Patagonia model and having it not be an exception, but an expectation. So I do think that 80 to 90% of the solutions we need already exist, and they need purpose-aligned capital to scale. To me, that's the biggest problem that I deal with every day, which is why, spend a lot of time trying to convert extractive philanthropic investment capital into productive, purpose-centered investment capital, right? Through all this money sitting in DAFs and this money sitting in, foundations and, government programs that are incentivizing certain kinds of business to incentivize this kind of economic activity. So it's just, we're going to get as much of this, everything is a seed. Capital is like water. We're going to get as much as we have water for that kind of economic activity. So we can sort of redirect the flow of water, and we can convert the capital towards more values-aligned, purpose-centered activity, which is, what go and spend time with Soren, and you can sort of see the results of that at scale, which is what you all have done, right? So I just think grateful that more and more of these examples are being lifted up, and I think the question is sort of how do we bring that to scale? How do we help other people learn about, understand, and start working with these tools because they're right in front of us.
Do we have time for one more here?
Yeah, do we? Okay, great.
Hi, everyone. Hey, I'm an undergraduate student studying political economy. I'm kind of curious in the idea of different corporate ownership as a tool for transition. So one thing I think about a lot is the transition in the energy sector in the U.S. from fossil fuels towards green energy, and a large a portion of the resistance against this is worker skepticism, that they feel like they will be detached from the owners. It's something foreign, kind of different. Do you think that there's an opportunity for worker ownership models, whether it's an ESOP or something else, to help mitigate worker skepticism when it comes to sectors that are undergoing transition, and how might that be used to get people on board for transforming sectors, because inevitably it's going to have to happen.
Melissa, do you want to touch on that?
This is a little outside of my area of expertise.
Maybe it seems like Taj was ready to go.
Go ahead.
Yeah, definitely in relationship to kind of transition from extractive to renewable energy or industrial agriculture to sort of community, the sort of sector by sector transitions. There are really I think, important strategies that are being developed in funds and organizations that are thinking about the just transition framework sort of grew out of this notion that if you've got an environmental movement that's going to shut down a coal plant in a town, that you need to be supporting those workers in relationship to a just transition for them into hopefully some other more regenerative economic activities. So there's a lot of sort of expertise and energy here, and ways of doing that I think are really effective. But the thing that I'll say a little bit off tangent is, imagine that in California, for example, all of our public utilities, energy utilities, were actually owned by ratepayers and not shareholders. How would those utilities behave differently? And that's sort of a different kind of stakeholder ownership. But I would say, like, we have energy companies in this state who, in order to, with the blessing of elected leadership, in order to maintain returns to shareholders, refused to put power lines underground when we knew that the winds would blow, those power lines would come down, and fires would then do what they did in Los Angeles, do what they did in Northern California over many summers, right? Because that was in the interest of shareholders, but it was not in the interest of the people whose homes and lives were lost through those fires, right? If we as the people who needed the energy and paid the bills, were the owners, then the management and governance of that would essentially likely be more in our interest, right? It's sort of the belief that if the people who are impacted have a more significant role in decision making, we're going to make better decisions on our own behalf, like in our household economies, in our energy economies, and I think we sort of think about workers as a core constituent in the context of this, and I think it's really critical to think about workers and communities as an integrated set of stakeholders.
Yeah, and it exists, right? There's rural electric co-ops, and 20% of power actually in the U.S. Is organized in that way. They're cooperatives where the ratepayers own. And those co-ops have been able to shift to renewables much better, much faster, because they don't have these same set of incentive structures. And to Joseph's point about what else needs to exist, the regulatory statute that allows these is only for utilities, right? When the rural electric co-op legislation was put in place, it was at a time where there was needed electrification in rural areas, and it didn't exist. And so this law was passed. It was very specific. And imagine if at that moment it was like, you know what? The right to associate, the right to create cooperatives of users needs to be broad-based across all industries, all sectors. We'd be in a very different place. So there's something about it exists in these corners of and we don't. It's there. We don't. It's like hiding in plain sight. And I think there's, that is what in a day where more happens with the federal government, that is what I hope for. Last question.
Hi, my name is Jacqueline Gattuso. I'm a nearly graduating MBA here at Haas. And I've spent a lot of my time in business school thinking and working on creative financing tools and structures for transitions. So in my case, typically climate transitions, but in this case, transitions to employee ownership. And it's never lost on me that there's this desire for this capital out there to help fund these transitions, whether it's patient capital, catalytic capital, concessionary capital, in this instance, purpose-led capital. But that those capital sources that we're looking for are, like to your point, coming out of DAFs or foundations. And that money was amassed through extractive methods and through, not employee-owned ownership, through ownership of shareholders that are making lots of money, or private equity that's, extracting a ton of value. And then we're asking for that capital to finance our transitions. And I guess I'm just wondering, if we accept the premise that that is the capital we need because it's non-dilutive or because it's not seeking such high returns, and then these transitions work, and then what will be the next sources of capital to finance the next transitions that we need? Or do we assume that we'll never need a transition again if these types of things work? It always kind of trips me up in my brain.
Yeah, what if it all works out beyond our wildest dreams? Then what? Yeah, what do y'all think?
I guess I would just say, I would encourage us to think in stages. And maybe early concessionary capital is foundation capital. And what is it? What can that move and unlock? What's the next stage? And to plan to this point about sort of the reverse Patagonia, I think an element of the reverse Patagonia has to be the pooling of purpose capital directed by purpose-driven enterprises. Unfortunately, we're a little broke right now, right? So we don't have all of that money. But I do think the long game helps me stay focused on this is a tool, purpose is a muscle, and it's swinging the hammer. And maybe tomorrow it'll be swinging a different kind of hammer, and that will build a thing that can help us get more tools. And that's, for me, an interesting question. More interesting than yes, you make a good point, but where do we go from there? I think how to use it is really the next level of thinking.
And it makes me think of the model in Italy, for example, where all co-ops contribute 3% of profits to a pooled fund that goes to support other co-ops. And so we could definitely imagine these kinds of models that we're planning for the future of what are ways that we make that self-sustaining.
Yeah, just ways in which, as we are able to generate more regenerative worker-owned, worker-led, community-owned, community-led economic activity, that will produce a surplus that can then be reinvested. We work pretty closely with SAGE, which is the Economic Development Authority of the Standing Rock Tribe, which led a whole fight to stop an oil pipeline through their community. When developers came to the tribe and said, hey, can we lease some of your land for a few $100,000 a year to generate a few $100 million of revenue through these wind turbines? And they said, no, we'll sort of do it ourselves. And with about $20 million of philanthropic grants and low-interest debt, they're building their own utility-scale wind farm, which will generate hundreds and hundreds of millions of dollars of revenue for the tribe. So the wind farm essentially is going to become their bank, because they'll be able to use that to lead the financing of their own regenerative agriculture projects, housing projects. They've got a whole economic development strategy of which the energy generation is going to provide the financing for. Amazingly, with only $20 million of philanthropic purpose capital, they're going to generate hundreds and hundreds of millions of dollars of revenue to be the lead investors in their own economic development strategies. And so that, when I sort of talk about localized community-led development, and in particular land, labor, capital, creativity, and energy, energy and technology are the drivers. That's where we can generate the surpluses at scale to shift the economy at scale. So, which leads us to the problem of the distortion that all investment is venture capital investment, all investment. If you're not doing something that's going to produce and meet the expectations of venture capital-led something, then you're not doing anything of economic value. And that's the biggest distorting thing that probably all of you are dealing with. So that's a big thing that we have to shift. So.
Yeah. Thank you all so much. Please join me in thanking our panelists. Thank you in particular to Soren. It is late in Denmark, so appreciate it. I know we didn't go into huge detail about the different models. We assumed some level of understanding, but our website, Transform Finance, has a whole library of resources that explains all the models in great details, and the handout, also the QR code, has all of those. So hopefully if you're like, what even was that, you can follow up. And then I think we have another 10 minutes here, and then we need to clear the room. So, but thank you all so much for coming, for your questions and your attention.